So stop writing, please. Head up. Head up. So we have the fifth adjustment, which is on interest. And when we talk about interest, this is when a business has taken a loan from the bank. That is what interest is about. Interest is the percentage of what you have to pay back based on the fact that you have taken a loan. That's why interest is what? The cost, the price of money. Interest is what? The price of money, which is the same as the cost of borrowing. So if you have borrowed money from the bank, you have to pay back the principal plus interest. So if you are paying back the principal plus interest, it becomes an expenses for you as a stop writing, please. Stop.
This interest in stems how?
Well, we're not talking about Islam, we're talking about accounting. Put your pen down, please. So the point we're making here is that there's interest, which is possible in accounting. So as soon as you take a loan, as soon as the bank lends you money, it is expected of you to pay back the principal and the interest.
I didn't understand.
That's why I said you should stop writing and focus here. There's interest, which is what? The price of money. When we say the price of money, it means the amount you have to pay back for getting a loan from the bank. That is your interest.
I didn't understand.
What is it that you don't understand?
What is interest?
I just said it now, it's written on the board. You just have to read and analyze too. Interest is the price of money, which is what? The cost of borrowing. The amount you have to pay because you borrowed certain amount of money from the bank. The bank has given you the money. So you don't just get it, you don't just give back to the bank the amount of money given to you. Because it is expected that the bank makes profit from whatever it gives to you. You should have done that in economics. So banks, they create money.
Mister, how much money do you pay back?
It depends. We don't talk about that. It depends on whatever you are paying back. It depends on the bank. So the point I'm making is that there's interest that has to be paid back because you have taken a loan from the bank. So we have interest receivable. Interest is received if you have saved your money into the bank. The bank will give you an interest. That's the benefit of saving.
Mister,
Interest paid what?
so you will give them back more money than you took.
That is what interest is. So there's interest payable, which simply means there's interest receivable. You have interest receivable because you have saved your money into the bank. We call it, hello please, hello, what's that? You should ask me and stop talking please. There's a fixed deposit. If you have done a fixed deposit, it means you will receive interest from your bank. But if you have taken a loan from the bank, it means you have to pay back a loan, the loan and the interest. There are two different things. When you, what? There's interest receivable. This means you are receiving interest from the bank because you have saved your money into the bank. So the bank gives you interest because you've saved. But if you are taking the money from the bank as a loan, you have to pay interest to the bank. It's vice versa. You pay the bank because you take a loan from the bank. The bank pays you because you saved your money into the bank. Interest receivable because you saved your money into the bank. Yes, you said what?
Well, I didn't understand what's the difference.
The difference is this. There's interest received because you have saved your money into the bank. That is interest received. The bank pays you for that. And there's interest payable because you have taken a loan from the bank.
But they are taking a small percentage from your money.
Banks.
Yeah.
No, it depends on the kind of account. If it's that's why I said fixed. Please, whatever I say, it's better you focus here. Because whatever I say, I continue with it, with backing it up. So there is a fixed deposit, which means you are keeping your money for a specific period of time. Yes?
Question. Why would you save money in the bank? It's a small percentage of income.
Interest.
Interest is like 1% interest. But when you loan money, borrow money from the bank, they take from you a big amount of interest.
Do you know why? Do you know why? Please, are you here? Going and coming, I don't really like it. From here, we have the 6% that has to be paid.
So we're going to do 12 months.
Yes. But no, you have to think about the start year, and the end year. Please look at the board, please. There's an information that you have taken a loan from the bank on the 1st of April 2023. Your accounting year ends 31st, 12, 2023. So between April, what? Profit and loss, yes. Because it's interest, you have to pay. Standard. It's interest, you have to pay back. So how do you pay? You're not just going to pay the whole amount. This is the amount you took from the bank. You are paying interest on that. The interest you are paying on it is 3,000 yet. But now there's additional information stating that it should be 6% per annum on interest. So from April to December, we have April, May, June, July, August, September, October, November, December. We have 9 months. It's not a full year, yes or no?
Yes.
So we have January, February, March gone. So we have April, May, June, July, August, September, October, November, December. 9 months. So our interest payable will be principal times time times rate over 100. So 9 out of 12 months we are paying for. Do we get it here, please?
Yes.
So 120 multiplied by 9 equal to 12 multiplied by 6%. 0, 0. 6 here, 1 here, 2. 2 here, 1 here, 60. 0. So 600 times 9, that was 5,400. 6 times 9, 54. What? 9 months
5,400.
between the year, I'm coming to 5,400, right? 9 months between the year you collected the loan and the year you want to pay back, the month you want to pay back. So that's 5,400.
400. You're gonna subtract from
Yes, you less it.
2,400.
Is it? Are you sure?
No, 1,600.
006. 1,600. So 1,600 goes to your account.
Provision for bad debt.
Yes. No, not provision for that. This is interest.
Ah.
So 5,400 is your interest, and this is amount due, which goes to your balance sheet. This is for this year. It goes to your profit and loss account, and this goes to your balance sheet because it is what? I said here, it should be recorded in the balance sheet. Amount due. This is the amount due. 1,600. Balance sheet. Yes. Because the total amount you are supposed to pay is 5,400, right? You have paid 3,000. So the rest goes to the balance sheet. Any question about it? Do we get it or not? This?
Can you explain from the first instead?
Really?
Can you?
I don't think I have that time. But do we understand this?
Yes.
Okay. We have interest. Please stand up. Yeah, and to the back. Sit down. Yeah, stop that already. So we have interest. Interest is the price of money, the cost of borrowing, the benefit of saving. You're taking money from the bank. As soon as you take money from the bank, the next thing you do is you have to pay back. Hello, are you here? The interest, banks, they do business. So it is not expected that when you give them 500, they're just going to keep that money into the bank. No. Banks are not going to keep the money. Why? Because keeping your money is a liability for them. Banks will not keep your money. It's a liability because they have to pay you back. It's not their money. I just told you now, it's a liability to them because they have to pay you back the money whenever you need it.